Friends, very often I observe the following. For example, traders use only a certain option trading strategy, exclusively selling options or working exclusively with directional strategies, only with calendar spreads, and so on. The trader only works with one type of strategy. This is not a good sign because it demonstrates a lack of trading flexibility. Lack of flexibility will definitely affect the trading account. And in this video, I wanted to demonstrate the whole wide range of options functionality, the variety of strategies and goals that can be built and achieved. The market is actively changing. The goals of an individual trader can change, so it's important to be flexible. Let's start with the simple and popular subject, selling options. Let's build a strategy on a relatively short option series. We can sell call options, put options, and we'll get the following strategy. This is a strangle, where we expect the price to stay in a certain range. It is a good strategy that works during a period of calm and low volatility, which can last for several months sometimes. What can happen is that a trader gets used to profiting from time decay, thinks that such a strategy will work all the time. The trader does not study the market, is not ready to actively manage risk, is not ready to use delta hedging, rolls, and in the end, the trader who constantly sells options suffers serious losses. Without time to actively rebuild his strategy during a sudden spike in volatility, such a strategy will only bring losses. There are speculative strategies, such as buying options. I suggest we review the example of using a regular straddle. This strategy counts on the fact that there will be some strong price movement. The price movement does not occur, time decay has a negative impact, and the trader loses money. In this strategy, the profit for price growth should be higher than the time decay, and the Rehedger robot developed by the AE Exchange allows you to handle the time decay, theta. This strategy is a good choice if you manage to catch the moment of growth of options IV from low to high. This is what we observed before the acceptance of ADFs of Bitcoin spot. When IV rises, the profile of the strategy rises, while we actively hedge its delta for free. Of the speculative strategies, I would also like to mention the vertical spread. Vertical spread is a great strategy when dealing with price movements. It has a limited loss and limited profit. Stop loss, take profit. The strategy shows good results with a ratio of 5 to 10. And now let's talk about investors. The easiest way for an investor to make money on options is to sell put options. By selling call options of strike 41 at a futures price of 42,300, we get a reward, compensation in the form of a premium for holding the asset and selling the put option. But if the price goes down, we get the basic asset, futures in our case, at the price of 40,500. After all, the investor's goal is to buy cheaper and sell more expensive. Put options allow you to buy cheap or get rewarded if the price goes up. When assessing risk, you need to decide for yourself how many futures you are willing to receive. For example, if the price falls, I am willing to bear the risk of 1 futures. There is another approach. This is also a speculation, but anyway. We can sell call options, and if you expect the price to rise and you want to short, you should short at a high price. By selling 1,000 options of strike 44,500, we get a break-even zone of 44,800. And if the price of the asset exceeds 44,800, we will get a Bitcoin short at 44,800. If we don't get the short, we get compensation in the form of $300. It is always important to know how many futures you end up with so that the risk does not come as a tragic surprise. Traders who work with ETFs or index futures often don't even know what risks they have. Very complex calculations. It is difficult to understand the actual amount of risk. Let's look at the classic example of buying put options. You buy 1,000 put options with a strike of 40,000, 1 Bitcoin. Pay insurance in the amount of the premium of the purchased options. You get a price level of 39,700. This is a safe level. And if the price drops lower than 39,700, you still close your position at 39,700, no matter how much the price drops. No panic, you still won't lose more than the premium you paid for the options you bought. Only options offer such opportunities. Now let's talk about arbitrage. I have a whole video on my channel dedicated to it. Watch it. Don't want to repeat myself. Arbitrage involves buying synthetic futures on one side and selling real futures on the other side. Or there's an option to buy synthetic futures at one strike cheaper and sell synthetic futures at another strike more expensive. The same opportunities exist with calendar strategies, where you buy a futures on one series and sell on another series, and pocket the difference. Arbitrage is beneficial where liquidity is low, so there are a lot of opportunities that options give you. So study options. This is real financial engineering. With them, you can successfully speculate, invest, hedge, receive arbitrage income. Don't limit yourself to just one type of strategy. The market changes, prices are changing, and you have to be ready for the changes. So, thank you for your attention. If you have any questions, ask them in the comments. Leave a like. I wish you all the best and successful options trading.